This is Taking Stock on Bloomberg. Well, the grocery business is supposed to be boring and predictable, but we all know that the shares, for example, of Whole Foods, they've almost doubled so far this year. And today, Kroger announced that its profit rose 13%. This exceeded analyst estimates, but the stock closed a bit lower. What's going on in the grocery industry? Well, let's find someone to help us clean up on, let's say, aisle 5. We'll pick a number. Simeon Gutman, he is with Canaccord Adams, an expert in walking the grocery aisles. Simeon, we've never been shopping together. Maybe we should try that sometime, see if you can pick out some bargains. What about bargains in the stock market? You saw what happened to Kroger's today. They came out and they said margins actually pretty good, but why? Because of their internal brands, right?
Yeah, their private label penetration is increasing year over year. You've seen that for a lot of companies, and that's just because people are trading down naturally, finding value in the store. The other thing that's helping their gross margin is the benefit from some of this private label, the expansion of the mix of their business. The other thing is the O&A rate, their expense rate, grew at a slower pace than it did in the previous quarter. So on net, their operating margins expanded a little bit faster than it did the prior quarter.
All right, so they're cutting costs, they're keeping a lid on spending. You're seeing this expansion of their private label branded business. When we looked at the results today, you also got to factor in what happened with gasoline, right? Because Kroger does sell gasoline, and you were making the point just before we came on that analysts might be missing something when they take a look at the gasoline sales. What is that?
Well, on a year-over-year basis, gasoline retail prices are down. But when gas prices typically fall, you tend to make more money on it. The opposite happened with Kroger.
Why is that, though, typically?
Well,
you just get that margin, that spread?
Yeah, well, when the price goes down, the retailers typically can hold the retail price stickier than where the wholesale prices are going, and you get a little bit more of a spread in the near term. And that was the conventional wisdom, and I think some people think that helped Kroger make the profit beat in the quarter. In fact, it was the opposite. It actually didn't help them at all. They did actually make about a flat gross profit year over year, and that was because they priced the gasoline more as a loss leader as opposed to as a profit driver.
All right, so get people in the aisles, get them shopping, buy those private label brands. What does that say for the future of the grocery business? Because, you know, we've talked in the past about this trend where people under economic pressure, smaller pay packets, as a result, they're not spending as much money as they might have in the past in the grocery aisle.
Well, it's a good question. I mean, private label in this country is only about half as a percent of the business as it is in other countries like Europe or in other continents. So are we permanently creating a shift whereby private label starts to become a greater piece? We could be, and I think economic conditions like these prompt some of those changes. So we definitely are seeing it. That being said, I still think there's been a trade down even in the supermarket store where you have people going from fancier cuts of beef to ground beef, beef down to poultry, some of the national brands down to private label. And just as I think there is pent-up demand in other sectors of retail, I do think there is some pent-up demand within the supermarket store as well. So I think some of that could start to migrate upward as the economy begins to improve.
All right, what about the stocks? I mean, for example, Kroger, Safeway, we'll even do Whole Foods in there. What's the outlook for the stocks right now? What do you like?
Well, I mean, I actually like Safeway the most, and I think part of what's working in this market are stories that haven't been too crowded. And I think you find a lot of stories where there's some margin growth, where there's a little top-line growth. People are basically ducking for cover in a big way in those stories. Safeway is more of a contrarian story. I think there's an overly pessimistic view that they have to invest their gross margin in a big way over a longer period of time. I think that's just the opposite. I think they're actually more competitive than most people think, and that through cost-cutting and top-line stabilization, they will get there. On top of that, they have a very big 15% free cash flow yield. And as soon as we start to see a little bit economic light, I think that free cash flow starts going towards share repurchase.
What about Whole Foods? Let me turn your attention there. We've talked about that in the past. I noted that the stock it's almost a double so far this year. Is that kind of more hope over reality, or what's the trend at Whole Foods?
I thought so. It was one of these too far, too fast. It's, you know, a high beta, high growth type of stock where you think if the economy starts to improve, their customer starts to return. You know, by and large, numbers are getting a little bit better. There's some cost cutting that's helping their business improve. You know, longer term, the question I have is, what does that store look like? Because I think they need to expand their addressable market, especially if we're talking about a more value-oriented customer longer term. And I think they have some tools with private label, but we're a pretty long way from seeing that happen.
And you've got Walmart coming into the organic business as well, offering that kind of produce. All right, we're going to continue the conversation with Simeon Gutman. We're going to take a trip away from the grocery aisle. We're going to talk about the pharmacy business. I want to find out if CVS Caremark, if that deal has worked out for investors, and is Walgreens in trouble? You know, after announcing disappointing earnings, that was yesterday. We're going to take a detailed look at Walgreens, also at Rite Aid. This is Taking Stock on Bloomberg. A programming note, Bloomberg's Taking Stock begins each weekday at 3 p.m. on Bloomberg 1130 AM, XM 129, Sirius 130, and on Bloomberg.com. This is Taking Stock on Bloomberg. I'm Pim Fox. My guest is Simeon Gutman, analyst with Canaccord Adams, expert in the world of grocery and also in the pharmacy chain business. Simeon, let's talk about CVS and Caremark. You know, we've been following what's going on really since the deal to put those two pieces together. And in fact, in your most recent note that I took a look at today, you're saying there's a real interesting thing that's going on with the prescription drug business at CVS Caremark. Tell me about how they're moving customers. They want to get people to come into the drugstore. They don't want to do just the mail, right? I thought mail was more efficient, mailing the prescriptions.
Well, as a hook to get employers to sign on to managing their prescription benefit, you offer this program called 90-Day Mail. The problem is it's not the most convenient for the customer. And the reason is, even though it's easy to get it in the mail, there are some prescriptions that you'd prefer to probably just pick up acute prescriptions, stuff that you don't have chronic needs for.
Right, stuff that you need right now. You can't wait a couple of days for it to come in the mail.
Right, so if you have an employer that tells you you can only get it through the mail, naturally that's not an easy thing for the employer to do. But if they're strapped for cost, that's a path they might go down. Well, with CVS, because they have this retail network and this PBM network, and they're already paying the costs of running these stores and they're paying the pharmacist to be there, they can say, listen, we can take this volume that otherwise you would be filling through the mail, and we're happy to fill it through our stores. What it really is, it's a clever way of just channeling traffic into your stores. It's a clever market share-taking tool.
And what have they found? Because you've done some research on this, right, which is that when you look at what people do once they get into the store and get those prescriptions filled, they also pick up some other things to buy, right?
Yeah, well, two things. I think in and of itself, the math of just having someone pick it up in the store works for CVS, meaning they make more money on that script versus filling it in a call center through mail. The second part is to your point, you know, they're not only getting that customer's new 90-day script, they're also picking up all of that customer's additional scripts, and you have an extra person in the store. Drugstore is based on impulse purchases. You pick up an extra impulse purchase on a relatively rich gross margin at the front end, and you drive more money to the bottom line.
Sounds like you like the shares. You got a $41 target on, you got a buy recommendation still, right?
Yeah, we do. And CVS is one of the cleaner stories in drug retail. I think there's a lot of money has come into it, and at this point, I think people are still questioning, you know, what's the next leg of the story. I think maintenance choice is the leg of the story. Of course, at the same time, you're talking about a valuation that's historically low, trading at about 10.5 times next year's earnings.
All right, we're going to have to leave it there. Unfortunately, we're going to have you back because I want to go into more detail in the drugstore and pharmacy benefit management programs. Thank you very much, Simeon Gutman, coming in from Canaccord Adams, sharing your expertise as well in the grocery aisle. Appreciate it.